So I look at this as, how do you define the right deal structure for the portfolio companies you're building? What's the cap table going to look like? And there is no one answer. There is no one standard. And there really can't be in this space because you've got studios that are building deep tech, biotech. You got studios that are building cash flow. You got studios that are the founder that take this all the way through to we've got a product before they bring somebody else in. And you've got studios that are acquiring IP there's such a breadth. There is no one answer. But what we can instead look at is what are the right frameworks we can use to understand what an acceptable range of equity really looks like and how does this deal structure come together.
Welcome to Startups Decoded, where we uncover what it really takes to build and scale startups. I'm Andy Walsh, founder and strategist. Each week we will bring you actionable insights and real stories. Let's dive in. Hello and welcome back to Startups Decoded. Today is something that I've been spending a lot of time on in the last year or so with Nobody Studios, but today talking to Matt Burris. Welcome to the show.
Thanks for having me.
It's really important conversation focusing on venture studios today. And venture studios as an asset class have been around for a while, but it feels like in the last couple of years, there's been an acceleration in the number of them globally, seeing some case studies and success. And there's a whole story to unpack around this. And to set up today's conversation, Matt, I'd love to be able to hear from yourself as far as your background and how you ended up in the venture studio space.
Absolutely. It started with almost burning my house down.
That's an answer that I've never had before. So we need to explore that a little bit too.
I thought it'd be a good tee up. So the first startup that I built was a metal 3D printer company. I started not with a minimum viable product, but a minimum viable test. I had to prove to myself that I could use a Blu-ray laser I bought off of eBay to melt metal and be able to print something solid. So let's start by melting metal. Melted zinc, bronze, and stainless steel, but I lit titanium on fire. So titanium ignites at 450 degrees Fahrenheit in an oxygen environment, which is kind of the basement. And luckily I didn't burn the house down. Nothing caught on fire except the titanium. So it was an exciting moment. And that startup actually connected me with the first studio I ever met in person. And they gave me some advice that got me into an accelerator in the Bay Area. That studio was in Bloomington, Indiana. They're really good friends with the guys that came together and started High Alpha. And they influenced a lot of High Alpha's design. So that was about 2010, I want to say, somewhere in that time frame. So about 15 years ago, I got connected to the first studio. That's how it all started.
Wow. I know that's probably evolved. When I was chatting to Ben Yoskovich at Highline Beta, he talked about at the time when he was first doing this, that it was probably more focused as a incubator as far as language. And then the venture studios came to life. What period was that? You talked 2010 when you were first jumping into that. Mm-hmm. How long before that was the venture studio term even around?
The terminology's evolved a lot, and the studio that I met back in my hometown, it was Sproutbox. Now they're a Paragraph. They were actually connected in with a lot of the accelerator networks at the time because accelerators still hadn't been fully defined. So they were trying to figure out what's the difference between accelerators and incubators and this thing that Sproutbox is doing. It's not either one of those. How does this all come together? And realistically, that's kind of the challenge that's gone on for the last 15 plus years. In fact, I'd say 30 years in total since the first modern studio got launched back in 96. And it's something we still struggle with a little bit today because we just have so many different terms for what a studio is. And everybody has different meaning attached to those terms. And that's created a lot of confusion just in the whole space.
Yeah, there's a lot missing from today's narrative still, even after these years of experience. And I think that we'll unpack a few of those today. Some of the things that we're looking at is legitimization and how does this become an asset class that not only grows and delivers great businesses and successful exits and returns for investors, but also is something that has enough structure so people see it as something they're aspiring to do and can make choice within the startup world, is this something that's viable for them? Because it presents a lot of interesting opportunities, particularly for the entrepreneur within that who's just perpetually coming up with ideas, and they don't need to be personally attached to them. They can just have this almost blank canvas of sorts, and we'll explore that. But I think as far as the formalization, I'd love to kick off with, at your perspective, where would you say like the market is at right now in the sense of venture studios, as far as perception in market, how legitimate they are, and to set a bit of a benchmark for our conversation?
I'd say it's still very early days. I would say that institutional investors do not yet consider venture studios to be a legitimate asset class, because I would point to the fact that they do not allocate money against it today, right? If they look at any asset class as like, this is a great one to back, they're going to set some allocation aside every year to put some capital at work in that asset class. We don't see that today. We do see institutional investors in the studios. So it's not that they are not aware of the asset, but it hasn't yet matured to the point where it makes it easy for them to deploy capital into it. And that's part of the mission that we have at the Venture Studio Forum, is to really define the asset class and help it grow into that point.
Yeah, and I see it and hear it colloquially from conversations, etc. And there's two sort of investment modes, right? There's the actual studio itself, which is in theory the incubation hub and the exploration lab of ideas, concepts, prototypes, etc. But then you go into the portfolio and you have a range of companies that then on their own right can get investment as well. And the studio side has some legal restrictions around it too, like for a VC particularly. Like they're not allowed to invest in something else that invests in something else as part of their operating agreement within their company. And LPs would not probably want that either. But I think the portfolio opportunity is real, and there's some things there that we should explore today to look at the state of play and how we can change that moving forward. But you talked there a little bit around the Venture Studio Forum. It's probably a great place to start our conversation and journey today. So that's been recently started. Can you tell us a little bit about the origin and what your mission is?
Yeah, so we've been in the space for a number of years, me and my some of my partners at the 9.8 Collective, and we've seen the repeated problem over and over that it's really difficult to raise capital. There's a lack of really well documented best practices in this space. The community itself is fantastic. Venture studios are really open with one another. They'll share insights and best practices, but bringing that all together so that the whole ecosystem can really take a major step forward, that's something that we've been missing. And so we said, hey, let's start a trade association, a nonprofit global trade association focused on elevating the venture studio as an asset class. So that means we need to go define it formally. We need to build up frameworks that allow investors to navigate allocating capital and evaluating studios easily and be able to compare them against one another easily. And that's kind of a challenge today. I think the comparison, I think studios will recognize this because they typically will pitch family offices. If you go to pitch a family office, well, you pitch one family office, you just pitch one family office. It's going to be radically different than the next one. And that's really the state of studios today. If you're an investor, you see one studio, you saw one studio. The next one that you see is going to be very different. And that makes that investor's job incredibly difficult. So we need to solve that. And that's what we're working towards today.
So good. And someone has to take the lead on that, right? It's for the betterment of the industry at a global scale, which has so many positive flow-on effects. And a lot of it is definition that you talked about, as far as like, how do you get a standardized set of terms? Investopedia is a really good example. Every day I get the email, and I'm pretty deep in this space, but there's terms that get thrown in there. I'm like, never heard of that before. It's never come up in my conversations. And I think giving people the language to be able to talk about it and understand the structure, but also the alternative models within that. And I guess that's the gray area right now, as far as what actually is it, how does it function, and how do people know what they're walking into? Because one size does definitely not fit all.
No, and that's one of the biggest challenges in the studio space. If we take a step back, question one, what is a venture studio? The way we define it is it's a company that builds other companies by taking a meaningful role, playing an entrepreneurial role, an operator role, and an investor role. So that creates a little bit of a framework where you can test, is a studio, one? Because there's a control element there. And there's very distinct roles that the studio is playing in building and creating that company. And that allows us to start, one, it's a formal definition, but we can see how well a studio performs in any one of those roles. And it also creates a nice separation between the other asset classes in the space. If I would look at an accelerator as a comparison, an accelerator definitely invests, right? They're taking an equity position, they're filtering for good deal flow, they're putting some capital at work, but they are not taking an ownership or controlling role as an entrepreneur. They'll advise, but they're not executing there, they're not owning anything there. They'll advise on the operations, but they're not doing any of the operations themselves. And if you just look at the time that an accelerator puts in on a portfolio company level, maybe a couple hours a week. A studio is usually on the order of 20, 40, 80 plus hours a week per portfolio company. So it's just such a different level of support that this kind of definition starts to really bring clarity to the value that the studio is actually adding in building those companies.
Yeah, and if you were to step outside venture studios or startups and look at the industry at large, the way that startups can be built now is becoming more automated, which is ultimately the thesis of a venture studio, which is how do you operationalize a linear process that allows you to take lessons from experts who are exited founders, investors that come from different backgrounds that can, at the right point through a process, add value, course correct, whatever they need to do at that point in time. And if you're a startup operator doing it for the first time, you can get on various GPTs and build out business models and things that you wouldn't know how to do yourself natively in a way and get a bit of a head start on that. And I think that that sort of formalization of startups at large, not even the asset classes within that, I think is becoming that point that I think ultimately will help venture studios long term.
Oh, for sure. Like a lot of those automation tools are going to benefit studios. They're going to benefit entrepreneurs of all types. The challenge is, and this is where I think studios are going to excel versus not going through a studio process. If you're doing this yourself, especially the first time, you don't have a point of reference to, check the AI, right? Because we've all seen AIs hallucinate. And sometimes they hallucinate really, really well. And if you're not an expert in that space, you're like, hey, that sounds reasonable. Let's go do it. And that can be a major mistake and a distraction. And one you'll make with great confidence now. So that, becomes the challenge. And a studio can look back at this and go like, that doesn't sound reasonable. We've experienced very different. If we have some data that points us in that direction, then that's a different story. But we've experienced very different. Let's not do that. Let's do the things that we know, that we've seen that work, that we have playbooks for. We've got teams that know how to go execute. So yeah, AI is going to help a lot. It's going to help the studio move a lot faster. But I think there's a balance even within the studio world where the studios are going to bring even more advantage into the model is level up the quality of what they do. So at a certain point, it's not about building more companies because every company you build takes a lot of resources, a lot of capital to deploy. So there's a balance between let's build more and let's build better. And overall, the studio model is focused much more on let's build higher quality companies that succeed at higher rates than let's build more. But AI is going to allow you a little bit more flexibility in how you approach that.
It makes a lot of sense. And I was reading some data the other day, and I can't think who put it out. It was PitchBook or someone else, but they were talking about fundraising success rates for first-time founders versus second or third. And if you're a second or third time founder and you've had exits, it's much easier to raise and be able to get enough capital to do what you're doing. And it doesn't, I don't know. I don't know if they followed through with this or not, but I'd be curious to see, does that actually increase the chance of success on returns? Because what that establishes is a pattern of data there. A repeat founder has the ability to drive greater returns. It's precisely what a venture studio does, is that expertise of multiple pieces, yet it still has this cloud over it, I would say, in the sense of what it's doing. So to step through some of those stages in a venture studio, I think trying to not fully unpack it, but set up typically how it would work. And because that gives us a path into looking at along the way, how does, say, an investor understand the value of a venture studio and help qualify and quantify what that looks like. So you've got to, like, let's start off with the entrepreneur side as far as ideas, prototypes, etc. What is sort of typical in that environment?
Yeah, so if we step back and look at that full process real quick, usually there's 5 stages. Everybody tweaks it a little bit, but you find some ideas, you go validate them. The ones that you do validate, that you determine are worth building, you start building. Then you grow them, and then you spin them out of the studio so they can stand on their own. Everybody approaches this process a little differently, with good reason, right? You've got studios like NLC Health or MDB Capital that build in biotech. They're licensing IP. That early process looks very, very different than somebody like High Alpha or Pioneer Square Labs or OSS Ventures, where they're going to search for some opportunities or take a problem space and look within it. So with that context, often how studios really approach this is, we're going to try to kill off the ideas that don't make sense, rather than, hey, I think this idea is good. Let me massage it and pivot it to something that looks like it can succeed. We're going to take a little harder look, and we're going to kill off the ones that don't pass sanity check, right? If you're building for venture capital, is there a path to becoming a unicorn? If there's not, like, we can stop now. Let's go look at something else that has that potential. Because if you build something that doesn't have that path and you put it in front of follow-on capital, they're going to say, yeah, no, like, they can't invest. So why did you waste all your time and resources and capital to build it in the first place? And so really that's part of the role of the studio. It's like, hey, sanity check. Let's remove our bias around our own ideas. Like, is this something we should go build? It's effectively putting in some quality standards, which I know just sounds like, oil and water mixing together, right? You can't have quality standards and innovation. Hold on. We know what successful innovation is going to look like, how the market needs to accept it at the end of the day. So we need to see some of those signs early, or this probably isn't something that makes sense to continue to invest in and build. And so early on, what does that look like? Can we see some indicators that this really solves a meaningful customer problem that's going to generate enough enterprise value to build? If we can't, then it's not saying that the idea itself is bad or shouldn't be pursued, but like, we haven't found evidence, so we can't move forward with confidence. So let's stop. If we find better evidence later that says this is a great idea, let's go do it. But it's having that discipline, like, hey, let's not waste time on the things that we can't find evidence that this makes sense to look at a little deeper.
Yeah, and the term that jumped out there for me is validation. And if you're at any stage of investment, any good VC or family office, private equity, whoever they are, one of the things that's in their top 3 list is, what does market feedback say? How do you know that you're creating something that people actually want or it solves their problem? And having some structure to be able to consistently validate products through every major step and even micro steps that happen through that way is important. And there's a little tension in that as well. And you touched on it there, like, where does human intuition come in versus validation? And there's been so many startups and products that have been built where if you were to ask an audience whether they need this or not, they would say no. But it launched, it became very popular, and then there was an adoption curve that happened, and people didn't know they needed it yet, but once it was out there in the world, then they went, I've got to have this. And that's seen around the corner, and only a certain number of people in the world have that ability to forget everything that they know and try and forecast a future state.
Absolutely. I look at this as the difference between data and insight. Henry Ford famously was like, hey, if I asked people what they wanted, they'd say a faster horse, not a car. Okay, fair. Data is only going to tell you part of the picture. Like, one, did you even ask the right people? Did you ask the question in a way that can give you data you can use? One of the best books on this is the Mom Test, right? We're really good at asking leading questions that don't give us insights that we should really rely on. Like, you love my product, right? Let's go build it. Yeah, I don't want to be a Debbie Downer and hurt your feelings. So yeah, your product's great. I think my friend would love it. Go talk to my friend, right? That's like, this is horrible. Get it out of my face. But we never interpret it that way. We're like, see, everybody we talked to loved it. It happens. It happens to all of us because we're human, right? This is not a knock on any one person. Like, this is human nature. And one of the ways around it is, okay, so you've got some data that you're basing some insights off of. You can go test that insight. So what's the easiest way you can test that insight? We actually did that recently. So one of the things that we've noticed in the studio world is raising capital is tough. Why? investors have a hard time understanding the model. Every studio looks different. The education time between first conversation and between when you get an investor ready to back a studio can be 18 months, even for the studios that have built multiple unicorns. Like, oh, there's a gap here. If you ask studios, the answer is probably something along the lines of like, can you give me some more inbound leads or like people that love to invest in studios? I'm going to go talk to them. Okay, yeah, that's one thing. But it doesn't solve the fundamental problem. Investors have a really hard time understanding what a studio is to invest in it. So we created a mock-up of what a Morningstar inspired report would look like on a venture studio. So it creates all these anchor points that investors are really familiar with. And we just structure everything, bring it all together. We showed it to some investors and some studios. And the response from investors was kind of stunning. Yeah, 30-minute meeting, 15 minutes in, they're like, we're in. Huh? We're just getting a sanity check. Is this something like we should do? We're like, yes. Okay, carry on. And that was about 90% of the meetings was like, oh, yes, please. Like, this is something I can share with my existing LPs, right? This is something that they can share with other investors because it helps them instantly get it. But if we asked people about it, it'd be like, I got a deck. I got a data room. I'm good. So yeah, there is that gap. And knowing, is the intuition something you should go look at and how to very quickly, easily test it. So the work that we did to be able to do that test cost maybe $60, a couple weeks, right? It's let's design up a mock report, what it looks like. We know we can go build it, so that's not the issue. Does it land? And the answer for us was yes. And that's one of the big assets we are building out within the Venture Studio Forum.
Makes so much sense. And just the simple analogy of comparing apples to apples as far as what they're used to seeing, because what we're ultimately doing to be able to legitimize this is to create education, comparative businesses so that they're assessed exactly the same way with the right data. So being able to share those resources with global venture studios allows everyone to have the same information, and it then raises the asset class like collectively at large. And to sort of click on that a little bit, I think it's important for today's conversation. Like anyone who follows you on LinkedIn knows that you share great insights and data on a daily basis. It's really powerful content, and you've grown quite a loyal following off the back of that. Can you talk to us a little bit about your process as far as studios you've spoken to, how you're getting that data, et cetera, and the volume? Because I know factually it's significant based upon the conversations that we've had.
Yeah. So this is built over years. And I'd say the real big tipping point, I got active on LinkedIn in, I think it was August of 2022. In December, I went viral. One of my posts had 1.5 million impressions. That led to like 500 DMs, and 100 of them were studios like asking for help and wanting to get in contact. And so that really ramped up the number of conversations with studios I was having and the ability to really look at how each one of these studios organize themselves to build companies. And over the course of a couple of years, I had the opportunity to look at well over 500 studios all over the world. Everybody approaches this a little differently, different nuances for different environments, different industries, different resources and skill sets that were available within the studio team that came together to build the studio. And that perspective allowed me to step back. So I was asked often, like, hey, can you help me design a studio? By looking at so many, I could take a step back and see some of the foundational patterns that really play out. And you can use a design pattern and turn it into a due diligence pattern, because that's how I'm going to do the design anyway. Like, does it work? Did we break anything fundamental to the model? If we did, we need to go back and fix it so that it does work. And so a lot of the design frameworks, really, we've pulled from those to create a lot of the frameworks that we use to evaluate and really categorize studios. And there's a couple of really big ones. I mentioned one before that's found its way into our definition of a studio, which is the 3 roles that a studio plays. A studio is going to play an entrepreneurial role, an operator role, and an investor role in the companies that they build. Another big one for studios is every studio has 4 customers that they serve with one product. This is where a lot of the complexity of a studio comes in, because you've got investors in the studio, you got the staff and the GPs that are working in the studio, you have the entrepreneurs that you're partnering with, and you have follow-on capital. Now, I use the term follow-on capital very, very specifically because it can be equity capital, like we're raising venture. It could be debt capital. It could be non-dilutive capital. It could be no capital. But knowing that end customer, if I look at a studio, let's take a big step back. A studio is a company that builds other companies. The product of a studio is a company. I got to take that product, spin it out, and sell it. I got to have that follow-on capital buy it. They got to back it. If they can't say yes, I'm in big trouble as a studio. So knowing your end customer is incredibly critical to designing a studio well, because I have to full control of what I'm building and how we're building it within the studio. But I have to build that company in a way that works for that follow-on capital source. So getting very, very specific on who that customer is really, really critical. And if I'm building for a Series A investor, that's very different than a seed investor, right? They want different performance, different team, different cap table. And if I miss, I can't raise capital in that portco without really changing the deal structure. Now I might have to go back to my investors and say, you know, the return I promised, we got to make some changes. And that does not usually end well. And that's kind of the challenge at the studio is you've got very few products and solutions ever have 4 simultaneous customers, and you do within a studio. And if any one of those customers says no, then the studio has some fundamental problems.
From my personal experience and all the conversations that I'm having as well, I've seen it firsthand where the follow-on capital becomes a major roadblock to be able to scale, even with momentum, and finding the right information and benchmark to be able to set up a longer term goal is like ultimately how do we get funded and how do we exit
Yeah.
with what we're doing. And that becomes a conversation that happens much sooner because to your point, if you just go to market and then start building a business and then think about follow-on capital further down the track, then that story that you tell is probably not going to sync up with broader, I guess, industry expectations on what they're going to get out of it. So what you're doing right now with the Venture Studio Forum is the ability to normalize and standardize a lot of those things and using that information that you've attained yourself from interviews, countless meetings, all the things that you've done, and now doubling down on that as well, which is amazing. And there's a couple of topics out of the back of that I'd love to look at. The first one, let's talk a little bit around the Venture Studio Index.
Mm-hmm.
So how do you have data that is authenticated, quantified, and valid for people to be able to reference? Because I use PitchBook all the time on here, things that I read, and people never second guess data on PitchBook. They use it and they swear by it, and it validates everything because the brand speaks for itself. The ultimate opportunity here with the forum that you've created is to have a similar type thing, right? Where you're able to reference something. So talk to us a little bit around the Venture Studio Index.
Yeah, so what we're building with the Venture Studio Index is effectively a Morningstar inspired like report on an individual venture studio. So we build that out based on the data from the studio itself. We're still in development right now. We're working with multiple investors and multiple studios. We're getting real data, like data room level data from the studio. So this is exactly what an investor would be presented with. We take that information and we, pull out and extract really critical key variables, key factors to look at so that you can do some comparison between studios as well. So there's a few big sections to it. One of the big ones that we start with is we categorize the studio. So normally if you look at a fund, it's going to be categorized by the risk profile of what it's building and the maturity of the asset that it's investing in. We can parallel this. So in studios, we look at, are you building for deep tech? That's really high tech risk, really high market risk. Building for venture capital, less tech risk, but still a lot of market risk. Are you building for private equity? This is a lot less risk overall. Or are you building for cash flow? I just want a profitable company that spins out distributions. All of those risk profiles are associated with asset classes that investors are used to investing in. And when a studio can anchor to one of those risk profiles and focuses on it, it shifts the discussion on what this studio does and how it does it from, oh, you're only doing venture, you're doing something really high risk, with, oh, you're just like an early stage private equity firm. You look a little different than what I had originally thought. And then rather than look at the maturity of the asset of the company that the studio is investing in, because studio builds companies, we look at the formation role, the origination role. How is that studio showing up in the companies that it's building? Is it the founder? Is it the co-founder? Is it a late co-founder? Or is it a refounder where it's using IP or acquiring an asset to use as the foundation to build from? And this lets us look across all industries, all regions, at studios that have very similar operational processes, risk profiles. The next big section of the VSI is really focused on evaluating the roles that it's playing. So the entrepreneur role, the operator role, and the investor role. We pull out some KPIs and some really critical foundational data points around a studio strategy. So you can look and start comparing these studios against one another. Okay, your strategy is, you've got a much larger team, you're doing a lot more work. This strategy over here, a lot smaller team, different equity amount, going at different, you're building to Series A versus building for seed investor follow on. So it gets very granular. That allows you to make very quick comparisons and determine, is this the right studio for you to really look at? And then if you're looking at two studios, how do they compare against one another?
Thinking out loud here a little bit, not an informed thought, but being able to compare side by side helps as well. So the people who may not be doing the right thing or calling themselves a studio when they're not really, there's a lot of things out there that can have a flow-on effect for the industry as a collective, rather than just even the business that has done the wrong thing. So I think that's important from a legitimization perspective.
And I'm going to double down on that one real quick because there's a couple of advantages to breaking out these three roles. If you look at the investor role, this is the role that investors are used to paying for in any fund vehicle, right? A VC is going to get a 2% management fee every year for 10 years to be an investor. If you look at some private equity firms, they're not only the investor, they also have an operations team. There's a little bit more cost associated with that. Regardless of how that cost gets covered, there's more staff, there's more value being added, there's expenses there. The new element in the studios is really that entrepreneurial role. But by breaking these out, you can really start to see, how is this studio adding value in each one? And then you can really look at, is it justified by their cost structure and how they're going to be returning capital?
Sense. And within that, will there be some sort of framework as far as, here's your typical venture studio as far as team, services, how they function? So, because that's what you need ultimately, right? You need to standardize it. You need something that says, here is a typical studio, and then you have variations that go upon that, and being able to identify them separately, I assume, is where you need to go.
Absolutely. So at the role level, we will be scoring every studio, and what that lets us do is create a threshold. If you are below this line, then you don't really rise to the level of a studio. And again, this is where that three role framework comes in really useful. Let's say we take our framework, the Venture Studio Index, and we put up a venture fund like Andreessen Horowitz. Okay, they're great investors, right? They're going to score above 95% of studios because this is what they do day in and day out. They've got a lot of resources. They got a lot of experience there. Operators, well, they have a lot of operational staff to support their portfolio companies, but they don't really own that. They act more like service providers. They're there to help. They're not there to jump in, do the work, and direct the strategy and then take responsibility for the delivery of that strategy. They're there to help. So they would not rise to the level of a studio. And then when we look at the entrepreneur role, they don't really take on an entrepreneurial role. So they wouldn't really score very high there either. And you could look across that and go, yep, not a studio. And so you can apply this to, any studio out there, like how well are you really doing any one of those roles? And every studio is going to show up a little differently in all of those. But if you're not rising to the level of a studio, then that's going to become very apparent from the data that we're pulling out.
So good and so important, almost to have a stamp of approval with what you're doing too, to hold people to account that they're not diluting the value of everyone else's efforts. And the follow-on question I have for that, and it's probably one of the most contentious in the venture studio world, is around the operator. And for studios that have a team internally and who are typically entrepreneurs, could be an entrepreneur in residence, could be a permanent team, but there's a collective of people that are looking at ideas, prototypes, testing, learning, doing all the things to have just a really healthy collection of startups that can either be paused, be pivoted, or go live. But once you get to a point where something is pushed live and it requires a transition from studio team into an operator, there's many different approaches to that as far as percentage of equity, titles, earning, all the things that go into any kind of agreement. And if you're a startup founder, you may bring in a co-founder 2 years into your business, and there's a conversation / legal agreement that needs to be worked through as far as who gets what and how decisions are made. I'm love to talk to you as far as there's different models where the studio takes a major percentage in the company and a co-founder comes in to get a minor equity share, and that has flow-on effect, particularly on the investment side. Or it can go the other way where a studio starts an idea, gets an operator in early, they get a major share, but the burden sits with them and they don't quite have the same support. Each valid ways of moving forward and different success rates, but I'd love to be able to unpack that a little bit with you.
For sure. So you're touching on an article that I've kind of outlined, but I haven't written yet. Definitely haven't published it. So I look at this as, how do you define the right deal structure for the portfolio companies you're building? What's the cap table going to be, going to look like? And there is no one answer. There is no one standard. And there really can't be in this space because you've got studios that are building deep tech, biotech. You got studios that are building cash flow. You got studios that are the founder that take this all the way through to like, we've got a product before they bring somebody else in. And you've got studios that are acquiring IP to there's such a breadth. There is no one answer. But what we can instead look at is what are the right frameworks we can use to understand what an acceptable range of equity really looks like, and how does this deal structure come together? So there's a few key factors here. One, what's the follow-on capital? What are their expectations? Because if you can't get a yes out of follow-on capital, we can stop talking. Like, this is not going to work. We need to go fix it. So that's usually number one. That's going to be a really big downward pressure on what the maximum equity a studio can take is going to look like. Then it's who's the founder, right? The expectation from the founder and what their options are if they don't go partner with a studio. You've got exited founders on one extreme, and you've got fresh, young folks coming out of high school or college at another extreme. Very different expectations. And those are just within more like the entrepreneurial spectrum. If you go to corporate America and you're pulling a career professional out of that environment, they don't have necessarily any anchor point within the entrepreneurial ecosystem to pull from. Their anchor point's corporate. And if you look at that, like, oh, what is a CEO that got hired in? What do they get? Not 1%. So if you show up to somebody like that, like, hey, we'll give you 5%, they're like, that's a fantastic deal. I would never get that in my corporate job. And in the entrepreneurial world, we go like, no. Although in the private equity world, it is. So really depends on what kind of companies you're building, what's the strategy you're building to as well. And then it's what is the studio providing? This is not just capital in, this is how much support. Some studios are providing hands-on support for 3 years. That looks a lot different than the one that's providing support for 12 months or less, and the degree of support. So there's a lot of factors that really play in. And one kind of wild card is what is the studio doing before they engage with anybody? So if you're licensing IP, that's really, really hard to do as a startup with no resources and no investment. So that kind of distorts what an acceptable range looks like a little bit. But that's generally how I approach it. You got to look at the individual basis. But a really big red flag that I always check first of all is, does this range work for your follow-on investors in your industry, in your region? Because if it doesn't, I don't need to look further.
Yeah, and the two examples I gave are probably at opposite ends of a spectrum, and a lot of businesses operate between both of those. But if you go into a situation where the studio retains majority equity, it's very akin to, say, an M&A business, right? Where they acquire a company, they bring in an operating partner who is responsible for driving that business, and they may get anywhere from 2 to 10%, call it, to be able to come in and do that. But there's an established business, it's a known entity, and it's quite structured. And that's quite standard. And you would get investment into that company, even though it's owned by someone else. Where on a venture studio, and I've seen and heard it myself firsthand, there's baggage around investors investing in a company that is majority owned by the studio. Do you have any insight there as far as where the blockage is and what the actual problem may be about why someone would back out of that investment?
There's a couple things. So I'll use one extreme example as well. If you look in, let's say, the biotech, pharmatech space, it's very common for investors to own the majority of that company very, very early. It's the nature of that business. So there are cases where that won't necessarily be a blocker. But to your point, if you're acting more like private equity, then the expected cap table range shifts drastically. I mean, there's a few ways you can go with this one. So one of the other big reasons where you see investors kind of object to investor-owned majority cap tables, especially the ones that are coming out of studios, there's a couple key reasons. One, their expectations in the market. They want to make sure, rightly so, that the founders and the executive leadership team is incentivized to stay. VCs will typically use a process where they're looking for one or two reasons to say no, they'll move on to the next deal. It's not about getting into the details. It's about, can I quickly say no to move on to something that looks like I can say yes to? Because you're going to invest in 2 deals out of maybe 1,000 that you look at in a year. Okay, quick heuristic for that from a VC standpoint, what percentage of the company is owned by investors versus employees? All right, you're outside of my range, I'm good. The challenge is the studio model is, hey, the studio is acting as a co-founder. But when the investor looks at it, they're like, you're an investor, not a co-founder. So there's a huge chunk of equity that now gets categorized very differently by venture capital and other potential follow-on investors. So that becomes an issue. Another issue is VCs will look at this and go, you're not playing by the rules. Right? VC's like, you're an investor, studio. I don't care about anything you do. You're an investor. You cannot take more than 20%-ish around. You're not playing by the rules, right? You get 2 or 3 times the equity that we might, because we're going to bring a friend in for any given round. We're only going to take 10 of that 20, and you're sitting at 30% or more, maybe. Unacceptable. I want that equity. There is an element of a little envy and jealousy there. It's like, hey, if venture capital investors could double or triple the amount of equity they own, their economics look fantastic. Well, yeah. Well, you got to earn that equity. And that's where the studios come in. They're like playing a very different role, putting a ton more work into all of those companies. I'd say, a VC, they're an advisor on the entrepreneurial side. They're an advisor on the operator side. They work on the investor side. So they cut off 2 areas where you can add a lot of value, but take a ton of work. The studios are playing those roles. So there's going to be a little bit more ownership. In fact, if I'm the investor in a studio, the studio's not taking enough ownership to justify the work that they're putting in, I got questions too.
Yeah, and I would equate it to almost when you have competitive VC funds investing in one company and who has more equity. And I'd almost put it down to one word, which is influence. How do they drive their own agenda with the path of least resistance? And if there's another serious stakeholder around the table, is there going to be tension? And are they prepared to take that on? And it may be a sweeping statement, but that's kind of an instinct that I have.
There's probably a little bit of that as well, because the studio has been in the trenches with the founding team for a year or more. And if you now look at the board level, the studio, say, has a seat and a pretty good stake. Who are they going to side with? The VC who doesn't have a lot of detailed knowledge and background around this business, or the founder? Well, they might side with the founder a lot more because they have a lot deeper understanding of that business. From the board perspective, that's great, right? You now have a really strong ally that knows your business very, very well. Historically, in VC companies, one of the big challenges is you get a VC that's come in advising based on what they've seen work in other companies in other industries or other segments. And that advice doesn't necessarily translate. But now you have to spend effort and time to go address that, and it becomes a distraction.
That resonates with me. And I did a little test mid-year in 24 on LinkedIn and sort of breaking down the equity models. And it was amazing. Just like it blew up.
Yeah.
It was so hotly debated. And it was a really good sort of experiment. And what you're doing with the Venture Studio Forum is actually doing that every day. So it's the ability to put things down the open, debate, solve, move forward. In your mind, what does a mature, sort of well-capitalized ecosystem look like in the world of venture studios?
That's a really good question. So, like, I think the asset class itself is still really, really in the early days. So, um, I don't know what the specific number is for capital allocation from major investors into the VC space, but it's pretty substantial, right? It's well into the billions a year. I'd love to see a meaningful percentage of that allocated to studios. That would be a mature asset class.
And it seems attainable, and my experience being in the front line for long enough now to do that. And I'm fascinated to see that happen. To wrap up today, to connect the dots there, as far as what you're doing with the Venture Studio Forum and the Index, you've recently just gone live. It's been quite a lot of work from a lot of people who are at the moment working for free to help make this happen. How can people help support what you're doing and help scale this? Because it's such a valuable thing that you're creating. It's not for profit, so everyone should feel passionate about wanting to support this.
I'd say step one is come on down and join. We've got a free explorer tier, so there's no barrier to entry. We also have a paid member tier, and that's where if I want to split these two at a high level, if you're an explorer, you're going to come in, you're going to get some resources, you're going to learn a lot that is going to help you in this space. In the member tier, that's where we start solving the problems that you have as a studio and within this ecosystem.
Yeah, great. And what I'd love to do is get you back on in the summer of 2026, and we can do a 1 year in what's happened, what progress has been made, and some success, because I think it's really important to do that. But for today, I think we've laid a really solid foundation for not just venture studios, but how we can collectively work together. So I appreciate you making the time, Matt, to join us today.
Absolutely. My pleasure. If I was going to add any one thing, there's a studio that we found as part of the Venture Studio Forum. We found them about 6-8 weeks ago. They're 30 years old. They're a public company. So they've been around a while. It's MDB Capital. They build biotech companies. They license IP. They build them. They take their own portfolio companies public. They've taken 17 companies public. 5 of them have become unicorns. What's that? Almost a 30% hit rate on unicorns. That's unheard of. And the fun part about MDB Capital is MDB is public and all of their portfolio companies are public. So anyone can go look this up, do the analysis. In fact, I'm pretty sure that by the time this comes out, there will be some published analysis around this. And it becomes, I think, a really key studio to kind of look at, because you can look really in depth because you've got all the public disclosures around it on how they build companies and the value that this model really can deliver.
And I love hearing those stories, and they're the things that people don't see or hear often enough as far as how successful it can be. And for any naysayers who may be skeptical and who's ever had any experience with a publicly listed company, the compliance required for reporting that company level is so significant. It's a whole team of people that have to do it. So that validation couldn't be more legitimate. It's how they retain their license as a business and stay on the stock exchange and doing what they're doing. So I think what would be great if there's any resources when this comes out, I'll put links in show notes. We can share things between us, but I think it's great for anyone to explore and get some foundational data themselves that they use to change their own perception.
For sure. I'll make sure you get it.
Amazing. Thank you, Matt. It's been a real treat.
Thanks, Andy. Same here. Same here.
You're listening to Startups Decoded. My name is Andy Walsh. Please share with your friends. I'd love feedback, anything that you'd love to talk about. Ratings are important for us to keep going. We want to continue to have these conversations. It's really important.